Hello everyone, welcome back to Just Invest Today. In today's video, we're going to talk about how to get to 100 bagger, 100x in the stock market. This is very important. A lot of people want to get this milestone, but you have to know how to do it, what to look for, and how to get in it. We're going to actually listen to the 2 ways that you can get your 100 bagger in the stock market. Mohnish Pabrai breaks it down for you. So we're going to listen to what he has to say. But before we do, we have to listen to Chris Mayer too, because he's the author of 100 bagger. He talks about how you get 100x in the stock market. He recently released a blog post talking about 100 bagger. This guy named Peter actually sent him some documents about Nvidia and how it actually turned into 100 bagger in 8 years. From 2013 to 2021, it was 100 bagger. So how did that happen? How did it do it? We're going to talk about it in this video. So before we do, like it and subscribe to my channel. Before we get into the Mohnish Pabrai interview and his quest for 100x in the stock market, we have to lay down the ground rules by Chris Mayer, because in that blog post, 100 bagger, that guy Peter, he sent him a binder of what happened during his 100x from 2013 to 2021. From that time in 2013, Nvidia was a $7.7 billion market cap company. It was selling for $12.50. But this guy saw the dominance of the GPU market already that Nvidia had, and the growth trajectory of the company. If the cell phone market got bigger, if the gaming market got bigger. So he kind of seen that growth trajectory going forward in a company like Nvidia. It was selling at a 14x earnings multiple at the time, but he wasn't really looking at that multiple. He was just looking at the growth trajectory of the company. Peter's thesis of Nvidia was pretty simple at the time in 2013. In 2013, Peter noted various reasons to own the stock, among them the dominant and growing market share in GPUs and the debt-free balance sheet with $3.7 billion in cash. The company was spending 25% of its revenue on R&D and a healthy pipeline of powerful products. Plus, the stock was trading at a 14x earnings multiple. And to get that 100x in the market, that $7.7 billion market cap has to turn into $770 billion, man. And just thinking about that is insane how quickly Nvidia became 100 bagger, because in multiple studies that Chris Mayer has laid out, it usually takes 20 to 25 years to reach that 100 bagger status. Nvidia only took 8 years for Peter. Nvidia benefited from that twin engine of multiple expansion and earnings growth. Chris Mayer actually lays out the strategy to 100x in a very simple math problem. If you want to get 100 bagger, you need to find a business that can compound its capital 25% per year for 20 years, and you will reach that 100 bagger over time. So you have to look at the dominance of the company, and if it's able to keep up with that dominance into the future, which is super hard to predict, because if a company is doing that, there's going to be so many competitors coming into that market, trying to take away market share, try to get into that market and just be as dominant as that company that's compounding that fast. On the valuation, I talk about the twin engines in the book, where you get growth but also increase in multiple expansion. It makes the journey easier when you get it. We see the twin engines here big time. From 14x earnings, the stock would trade for an average of 100x earnings in 2021. Put another way, it went from trading at 90% of the market multiple and 3.7x the market multiple. Think about that. The business itself was getting better, but you had to suss it out a bit. It wasn't obvious. There was no eye-popping growth or high returns on capital or any of those things. A lot was going on under the hood. The gross profit margin, for example, has gone from 34% to 52% in the prior 4 years. Still, I have to say, this was not an obvious super performer looking at the financials back then. The case seemed built more on growing importance of GPUs in video games and cell phones and Nvidia's dominant position in the market, and then peeking around the corner to see how the business would soon grow tremendously and earn high returns on capital. That was Peter's basic thesis of a dominant position in the growing market of the GPU sphere. He hit it on the tail because Nvidia just took off going forward. But that doesn't come with struggles, because back in 2018, Nvidia went down 51 to 57%. So you're going to see a lot of these 50% drawdowns that you have to overcome and stick to your thesis. Also, there was a lot of sell-side recommendations from analysts all the time, and in Peter's notes he kind of goes against that, saying like, how is this possible? He was confused. So you have to just ignore all these short-term theses and all these people saying this is a sell or this is a buy, whatever the analysts are saying. Also, Nvidia missed a lot of earnings in those 8 years, and people would come and say, oh, it's time to sell it, it's not improving anymore. So you have to just avoid all the news and all the drama and all the sell side recommendations. Look at the company long term. Is it improving? Is the revenue growing? Is it getting better margins, etc., etc.? That's what you really got to look for. Now we're going to get into the Mohnish Pabrai interview where he talks about this 100x in the stock market and how you get there.
There are two different frameworks that one can employ. So it's a way to get 100 bagger. One could get 100 bagger on a company that is never going to grow by buying it at 1% of the. Right. So if something is worth $1 billion and you were able to buy it for 10 million, and you were pretty confident that $1 billion value would not go down, you might have yourself. And I'm not trying to be facetious, but I want to point out that Charlie Munger says that the greatest investing mistake of his life was a friendly broker called him in 1977 and offered him 300 shares of an obscure pink sheets company called Belridge Oil. Had a very large oil field in Bakersfield, California. And Charlie was familiar with this company. It was very thinly traded, wasn't much disclosure, but he knew that at the price he was being offered those shares, at that time, I think the market cap of the company was something like $120 million. And the dividend yield was like 15%. It was very cheap. And Charlie said that without even doing much of an analysis, he knew they were using it for 1/5 or 1/10 or less of the actual underlying assets were worth. And it was quite a remarkable field, and they owned the land. It wasn't they owned everything under. And so he bought the 300 shares at $115 a share offered. And then 2 days later, the broker called him back and offered him another 1,500 shares of Belridge Oil, again at the same price. This time, Charlie didn't have the cash handy. He would have had to sell something to buy Belridge. And he sold because whatever else he owned in his portfolio was not a 20-cent dollar or something. It was not that cheap. But it required him to sell something and money and buy. And he called the broker back and applied. And he said that, so 2 years later, this 100 million market cap company was bought by Shell Oil for $3.5 billion. And it was like 30x or something. So it was a 30x in 2 years. And at that time in 79, Berkshire Hathaway was trading at about $300 a share or something, which is now approaching $500,000. So if you think about Charlie's the 30-odd thousand he put in, it became $1 million in 2 years. And then from was another probably more than 1,000x, or 1,500 or 2,000x from there was the journey from Berkshire. So that million became something like $1.5 billion today. The 30,000 in effect became $1.5 billion, 35,000. The 1,500 share that he passed would be worth something like $7.5 billion, which I think exceeds his total net worth. And so now, well, this is the kind of like I would say, what would I call it? I would say it's a cross connect, where you take the first company and you get a 30x. And then you take the second company, and in his case, he got a 1,500x. So you end up with 45,000, crazy number. And then well past the 100x, we're not in Kansas anymore. And that was now the second company that he invested in, Berkshire Hathaway, was a great growing. And that generated a lot of the returns because of growth.
You can either get it at a very cheap valuation to get to that 100x, or you can buy a growing company. You have your own decision to make on what route you want to go. Mohnish Pabrai finds the former easier to do. Guys, what are your thoughts on this? Like and subscribe to my channel.